The car market has experienced a dramatic shift this year. The shift in price has significant implications for both buyers and the automotive industry as a whole. Experts are predicting even more substantial price declines in the near future, and the signs of this anticipated crash are already evident. Let's delve into the details of this significant market shift and understand its potential impacts. To make sense of the current state of the car market, it's essential to grasp the concept of days of supply. This term is commonly used in the automotive industry to assess the balance between inventory and customer demand. It looks at how long existing inventory would last if sales continued at their current rate. The calculation involves dividing the current inventory by the average daily sales rate over a specified period, typically 45 days. Low days of supply indicate high demand and the potential for inventory shortages, prompting dealers to restock quickly. Conversely, high days of supply signify low demand and possible inventory surplus, needing strategic adjustments like discounts or production cuts to avoid overstocking. Several automakers find themselves in a difficult position with extensive rows of unsold vehicles and high days of supply. Ford in the United States serves as a huge example, with some truck models having a whopping 250 days of supply. This shift in the U.S. car market reflects a transition from record high prices to a potential price war, primarily driven by vehicle oversupply. A recent report by UBS Global predicts that car production may surpass sales by approximately 6% in 2023, resulting in an excess of around 5 million unsold vehicles. These surplus vehicles are expected to require price reductions to stimulate sales, creating a competitive pricing environment. The price war has already begun in the electric vehicle sector. Some manufacturers have slashed prices in response to market conditions, with Tesla, for instance, reducing prices up to £8,000 in the UK in January. This strategy aims to make EVs more accessible to potential buyers. Other car manufacturers, like Ford and Lucid, have also followed suit by lowering their EV prices. The softening of car prices is not confined to any single segment. Data from Cox Automotive in April revealed a 2.4% decrease in wholesale used vehicle prices in March compared to the previous year, though a modest 1.5% increase was observed compared to the previous month. Furthermore, a report from Kelley Blue Book in March indicated a 3-month consecutive drop in new vehicle prices, suggesting a sustained trend. While the car market has grappled with affordability issues as new and used car prices soared, the current trend is showing signs of reversal, potentially benefiting those in the car market for a new vehicle. As prices fall and incentives increase, consumers can seize the opportunity to purchase a new car at a more affordable price. However, for people who have recently taken out significant loans to finance their vehicle purchases, the falling car prices may present challenges. Car owners in the U.S. are experiencing a decline in their loan-to-value ratios, LTV. This means that the amount owed on their car loan surpasses the current value of their vehicle. The decline in vehicle values comes after a period of dramatic price increases during the pandemic. In May, the average interest rate for new car loans rose to 6.4%, up from 4.6% a year earlier. Although the average price of a new car fell by 2.5% to $36,472, it's important to note that this decrease occurred in the midst of rising interest rates. The LTV ratios for used cars have increased from 104 in the first 3 months of 2021 to 125 in the same period in 2023. This means that borrowers' loans are now worth 125% of the vehicle's value. While higher LTV positions make vehicle purchases more affordable in the short term, they can pose a risk to borrowers if unforeseen circumstances, such as job loss or financial difficulties, arise. These higher LTV positions may lead to difficulties in selling or trading in vehicles without experiencing significant losses and could result in repayment challenges, potentially causing issues. The combination of rising inflation and tighter credit conditions is making it challenging for individuals looking to buy a car. The increasing cost of living and less accessible credit is affecting potential buyers' ability to afford new vehicles. Consequently, there's a higher number of unsold cars sitting on dealership lots. This situation is compelling manufacturers and dealers to reduce vehicle prices and offer substantial incentives to attract buyers. With a massive inventory of unsold vehicles, competition among manufacturers intensifies, leading to more price cuts as the pressure to sell mounts. manufacturers may need to maintain lower prices to remain competitive in the market. The ongoing downward pricing trend could lead to vehicles losing as much as 50% of their current value, posing challenges for automakers and dealers as they face significant financial losses on each car sale. Electric vehicle manufacturers, in particular, may be severely affected, as many of them already operate with thin profit margins. On the flip side, consumers in the market for a new car have a unique opportunity to benefit from this situation. As prices drop and incentives increase, prospective buyers can seize the chance to acquire a new vehicle at a more affordable price. To maximize this opportunity, potential buyers should closely monitor market developments and price trends to identify the right time to make their purchase and secure a favorable deal. The car market crash of 2023 is becoming increasingly significant and could have far-reaching economic consequences. The used car market is plummeting. Automakers face production disruptions and inventory shortages loom. Wall Street banks have raised alarms, warning that this crisis has the potential to disrupt the economy and impact financial markets. The labor strike that began with the United Auto Workers Union has added another layer of uncertainty. The strike against General Motors, Ford, and Stellantis is unprecedented, affecting about 43% of new cars sold in the U.S. If the strike continues for an extended period, it could result in supply chain disruptions, potential inventory shortages, and price spikes in the car and truck market. This strike could have ripple effects, leading to price increases for specific vehicles affected by production delays. A month-long strike, for example, could cause roughly 10% increase in prices for affected vehicles. The situation may escalate if the strike spreads, leading to more significant disruptions in the automotive supply chain and potential production halts. The economic impact extends to inflation. Higher prices for new vehicles, combined with supply chain disruptions, could add to inflation pressures. This inflation could, in turn, impact U.S. economic output and payrolls, potentially contracting GDP and causing further economic challenges. This market shift is not isolated, it's intertwined with the challenges in the auto loan sector. Subprime auto loans have been a long-standing feature of the market, and investors have poured money into bonds backed by auto loans. The auto loan balance in the U.S. has surged by 28% since 2020, reaching over $1.5 trillion, becoming the fastest-growing consumer debt category. This growth was facilitated by the bundling of auto loans into securities and their sale on Wall Street, where they were labeled as relatively safe investments. However, a rising number of loan delinquencies and defaults have emerged, raising concerns about the stability of the auto loan market. The Consumer Financial Protection Bureau, CFPB, has taken legal action against several lenders in response to potentially predatory practices within the auto loan sector. One of the most alarming indicators of these concerns is the rising number of subprime borrowers who are falling behind on their auto loan payments. Problems of 60 days or more have now reached levels not seen since at least 2017. This troubling trend raises red flags about the stability of the auto loan market and the potential risks it poses to both borrowers and the broader financial system. As the auto loan market faces challenges, addressing these predatory practices becomes increasingly critical to ensure the financial well-being of borrowers and the overall stability of the lending industry. The potential for mass defaults poses a risk to the financial system. Investors, companies, and banks with exposure to auto loans could face significant challenges if the situation deteriorates. This issue is not just about auto loans. It has broader implications for financial stability. The car market's unexpected crash in 2023 is a complex situation with many implications. Buyers are presented with opportunities to purchase vehicles at more affordable prices, but those who recently took out loans may experience challenges with declining car values and increasing interest rates. The ongoing labor strike and supply chain disruptions add another layer of uncertainty, impacting the broader economy and inflation. The auto loan sector faces challenges as delinquencies rise, posing a risk to financial markets. Buyers and industry stakeholders need to stay vigilant, monitor market trends, and adapt to changing conditions. The car market crash of 2023 is shaping up to be one of the most significant events in the automotive industry, with consequences that extend well well beyond the showroom floor. What do you think about this crash that has a likelihood of affecting us in the long run? Let us know in the comments below. Like, subscribe, and click on the bell icon to stay updated. Thanks for watching. Bye!